This podcast is for informational and educational purposes only and should not be construed as investment, tax, or legal advice. Any examples or frameworks discussed are general in nature and may not be suitable for all investors. All investing involves risk, including the possible loss of principal. Past experiences and planning approaches do not guarantee future results. I spent a long time working with people who were specifically self-employed and didn't have any employees. And I love that space because there's so much flexibility and creativity that could go into their financial planning. So that's the theme that I wanted to go into for today's podcast episode. And I'll go over the 7 moves that I would make if I were self-employed and playing the long game. So the first is entity selection and using that to take advantage of the pass-through entity tax, which helps mitigate the SALT tax, the state and local tax cap that is a big problem in a lot of states, one of which is California, where I live. And this does include some legal decision-making, so you shouldn't just do this in a vacuum. You should definitely talk to legal and tax counsel. But ultimately, you could choose to use an S corporation where you could potentially reduce payroll taxes by structuring your reasonable salary against your business profits. Whereas if you are just taking your income in on Schedule C, then you are paying payroll tax, also called self-employment tax, on all of your net income. And it gives you that flexibility in how that income is distributed to you. Now, if you're looking to build up something bigger, you might want to consider a C corporation instead. And that could create a long-term opportunity where you avoid paying tax on your capital gain by using the qualified small business stock exclusion. So this is really more thinking ahead of whether you're going to sell your business and you're looking for a large multiple on your exit. S corporation, it might be better if you're just you just have like a practice going on. You are using your skill set to serve your clients, but maybe you're not selling any products. Another reason why a C corporation can be useful is if you are strongly reinvesting in your business, not taking distributions, then that can help you manage your taxes as well. So if you layer on top of your corporate structure the SALT pass-through entity tax election, then you have this potential to convert some of your state taxes into federally deductible expenses. And it depends on your state's rules and your personal circumstances. It's something that I've done and I've seen lots of clients do, and it's been very useful to help keep more dollars in my pocket. And the nice thing is it improves underlying cash flow, but it doesn't really change your underlying business operations. Number 2 is using the solo 401k. So if you're self-employed and you don't have any full-time employees, then the solo 401k gives you an opportunity for terrific tax advantage saving and investing. The high contribution limits are exactly what they are if you're working for someone else and you have a 401k, which is far beyond what you get in an IRA. And you get the ability to choose whether you want traditional or Roth. So traditional being tax-deferred growth or Roth being tax-free growth. You design the plan, you get to decide. And unlike an IRA, you don't have income limitations that may prevent you from doing one or both of those. The other nice thing is you have flexibility to adjust your contributions year by year. Now, here's where I see the solo 401k dovetailing into the multi-generational planning that I like to do. You're really not just saving taxes today, but you're deciding where the future income tax liability is going to land. You do have some control. Some of it is out of your control, but ultimately you can figure like what's going to happen in my lifetime or my children's lifetimes, or could I eliminate the tax burden entirely through Roth growth? It's a way different conversation than just how much can I contribute this year. Number 3 is spousal participation. This is a great way to just double your tax advantage savings. You just bring your spouse into your solo 401k plan. Now, it only works if your spouse is already involved in the business or can be reasonably employed by it. But if you can make that happen, then there's some big opportunity there for additional tax savings. Depending on how you structure it, you could effectively double your retirement contributions, accelerate your tax advantage compounding, and then increase that flexibility we just talked about with future distribution planning. And that's what changes it from just being individual strategy to being family level strategy. Number 4 is the HSA. That's the health savings account. And I see people treat this like a checking account, which is fine, but I think it's a mistake in high net worth families. So the way that it works is you get a tax deduction for contributing to the HSA. It grows tax deferred, and then you can pull it out tax free if you use it for qualified expenses. And you might have heard this thrown around before. It's called the triple tax advantage. Now, for high net worth families, I think the best approach is to pay their current healthcare costs out of pocket and let that HSA grow untouched. And then later, you can use it as a tax-free reimbursement pool against your qualified healthcare expenses. And then ultimately, if you, for whatever reason, decide not to use it for that, or you're unable to use it for that, you can pull the money out when you're 65 and you'll just pay ordinary income tax on the money that you pull out. Basically, it reverts to an ordinary IRA account, which is not such a bad thing. Now, there are rules about what kind of health plan you can have to be eligible for an HSA. Not everyone can do that. So you'll want to make sure that your plan is a high deductible health plan that qualifies for that. Number 5 is having an accountable plan. This one's really just about being organized. You reimburse yourself for your legitimate business expenses that you paid for personally, and then you avoid those reimbursements being treated as taxable income. There's nothing shady here. There's no creativity involved. This is just about being disciplined and staying organized and reimbursing yourself according to the schedule and rules that you put into your accountable plan. So not a major thing, but over the years, it certainly adds up, especially if you're in a situation where you have to pay legitimate business expenses personally on a somewhat regular basis. Number 6 is paying your children. And I like to say this is where family planning and tax planning intersect. So hiring your kids to do legitimate work, it can shift income to a lower tax bracket from yours to theirs. You could also potentially avoid payroll taxes if you don't use a business entity. That sort of ties back into the first thing that I said. You do have to structure it appropriately and decide what complications are worth going through to make this happen. But even if you don't avoid the payroll taxes, it still can shift income to that lower tax bracket. And then you have an opportunity to also fund a custodial Roth IRA for them. And now they can start growing their investment portfolio in a tax-free environment. And you can teach them about how to invest. And I think the long-term impact there is enormous. You're not just saving taxes, you're giving your kids earned income, investment exposure, the compounding tax-free for potentially decades, and also an opportunity to work and learn about your business. And I think using that as an early wealth transition strategy is so beautiful. It's not going through an inheritance. It's really just early participation in the family stewardship of wealth. And then number 7, the final one, is real estate professional status. And this is only applicable if you can legitimately achieve real estate professional status. You got to be working in the real estate industry as a certain type of person. For instance, lenders in the real estate industry don't count. So you have to make sure you qualify, and not just that, but that you spend at least half your time in that field and that you're working at least a certain amount of hours per year. So something that you want to coordinate with your tax professional about to make sure that you legitimately qualify and that they will sign off on it when they prepare your return. But using real estate professional status for a family that heavily invests in real estate can create huge tailwinds to your long-term growth. You can allow more losses to offset ordinary income and unlock deductions that otherwise could be limited. So that just increases your cash flow by saving money on tax. Now, in my opinion, none of these are overly complex. It's really more about coordination. And all those items, all 7 of them, they have some interplay. The income structure influences the retirement contributions. And then the retirement accounts influence future tax brackets. Family employment influences generational wealth transfer. And even the healthcare strategy we talked about, that influences long-term tax-free assets. So individually, each of those pieces help. But when it's all tied together, you create this wealth accumulation system. I love these 7 pieces all coming together because it gives you flexibility, it gives you optionality, and ultimately I think it gives you legacy.